prices, inflation starts to rise. Consumers are hit because they have to pay more for gasoline. What would happen in the case where you have rising commodity prices, as we're seeing, for example, in agriculture or energy, and the economy begins to weaken? Does that put the Fed in a bind?
It should, but it won't. Let's say, hypothetically, the oil price goes to $150 for whatever reason, and the economy weakens as a result of that. Mr. Bernanke will come out and he will implement QE3 on the basis that the energy price increase is temporary. That's what he said about every price increase for the last 15 years. It's temporary. And I think that if the oil price really went up, and don't forget, the oil industry is very simple. For the producers of oil, whether it's Venezuela or Iran or Saudi Arabia or North Dakota, rising prices are revenue increase. And for the consumer, it is a tax. Now, there are far fewer oil producers than users. So basically, there's a huge tax on the consumer in the world when oil prices go up. And if oil prices go up, gasoline prices go up, and heating oil prices go up, people have less money to spend on discretionary items. They spend it on the necessities, namely they have to drive to work, they have to heat their homes, and they have to air condition them and so forth. And so the Fed would step in my opinion, and print. And this is precisely the danger point we're at the present time. What we could get is actually a weakening economy, but price increase.
You know, we're in what we call here in the U.S. the silly season. You made reference, it's a presidential election cycle where politicians are kissing babies and promising voters free lunches. The administration, Mark, has the advantage because they can direct spending towards key interest groups.
Sure.
I would imagine one of the president's best friends is Ben Bernanke right now. I've interviewed a lot of experts recently who feel that 2012 is going to be an okay year because politicians will keep the market and the economy pumped up all the way up to the elections. But a lot of people have pointed out in 2013 and 2014, we faced some real headwinds. With fiscal drag kicks in, we have the massive tax hikes that will go into effect with the repeal of the Bush tax hikes plus the Obamacare tax hikes. Then we also have the fiscal spending cuts that were agreed upon in August of 2011. Do you see the future playing out okay, let's say this year, but maybe problems next year?
Well, I think the problems may already start this year because the market is a discounting mechanism. And, the governments, they have limited power in steering the economy. They may wish to make it look good and so forth, but it may not succeed. But incidentally, I don't believe that the Bush tax cuts will be repealed. In other words, I think they will continue because most likely we will have a Republican Congress, and so the deficit will stay very large in the U.S.
Mark, you live in Asia, and it seems like every 3 months here in the U.S. we get the China bears that come out and talk about a hard landing. From your perch where you live in Asia, and what you observe, how do you see China's economy going forward? Is a hard landing a likely scenario from your perspective? Or is China likely, and if it is a hard landing, is this the next big bubble that's to burst? Or is it possible they could dodge a bullet and perhaps get away with a soft landing?
Well, my sense is that the hard landing is unavoidable. But the question is, will it this year or next year or in 2014? Because as is the case in the U.S., you can postpone problems for a while, but not forever. And the principal macroeconomic problem I see for China is that the economy was largely driven by capital spending and 2008 by huge government stimulus and expansionary monetary policies. And if you have overcapacity, you can essentially continue to build capacity, but the end result will then be even worse. So I think they may be able to kind of postpone the hard landing, but I don't think they can avoid it. just a question, will it happen, say, 6 months' time, or will it happen in 2 or 3 years or 1 year? But I'm quite convinced the Chinese economy will have a hard landing.
I want to move on to the topic of gold. And as you've been a strong believer in gold for as long as I've known you, Mark, with all of the money printing, I imagine you still feel strongly about gold ownership. Do you feel the same way towards, let's say, gold equities, which have been underperforming?
Well, by the way, I want to revert to your earlier question about China. You know, if you look, say, at the industrial commodity prices, whether it's nickel or aluminum or copper and so forth, they're not acting well. And so that would, in my view, kind of signal a more significant slowdown in the Chinese economy. But coming now to the question of gold, yes, I still like gold, but you know, I have argued since last September that we reached an intermediate peak on September 6th when the gold price went to $1,921 per ounce. And then we collapsed down to $1,522 on December 29 of 2011. And then, as you know, we rebounded, and then now, more recently, we fell again. I think we may test the lows of December around 1520, and possibly we could even break them on the downside. But, you know, we had a big move in gold compared to equities since 2000, and incidentally, even today, year over year, the gold price is up, I think, 9 or 10%, and the S&P was on May 2nd, 2011, at 1,370, and we're now at 1,397. It's not a big deal. We're hardly up 1%. So gold has actually, over time, done very well. Problem is, some people bought it, obviously, at $1,900, and now they're sitting on large losses and so forth. But I have confidence that in the current environment, investors should own some gold. They should as an insurance. And in fact, if you have a diversified portfolio of, say, cash, real estate, bonds, equities, and gold, you should actually wish that gold doesn't perform well, because that would be a symptom that we are returning to sound money. Now, I don't believe that we will return to sound money. I'm just saying that basically as an investor, if gold performs badly, the other assets, including the purchasing power of money, will do well. The gold shares have performed miserably, and there are several reasons. First of all, usually a mining company, whether it's Newmont or American Barrick or so, they do not exclusively produce gold. Gold comes as a byproduct or in combination with some other industrial commodities, such as copper. And the industrial commodity component is obviously weak, as I just mentioned. Secondly, globally, there is a trend towards asking for higher royalties or a higher percentage ownership by governments in the projects and so forth. And so the profitability of these mines is under kind of a threat. The third problem is you have a lot of exploration companies. I'm on the board of some of these exploration companies. I can tell you 90% will not get the financing, in my opinion. And an exploration company, you know, it's not like a food company or a cigarette company that has an established cash flow and relatively low capital expenditure. An exploration company has zero cash flow, zero, but huge capital expenditure, huge.
You've been a strong advocate of diversification because you believe it's very difficult to predict the future with any certainty, especially at a time when governments are intervening. I know, for example, in my own case, Mark, I'm diversified in gold, energy, dividend-paying stocks, and real estate. And therefore, even though gold or even gold stocks have not done as well recently, dividend stocks are doing well. Rents on real estate have picked up. So I wonder if we might just spend a few minutes and talk about the importance of diversification in a market where I see a tendency, even in the gold camp, for example, I see individuals that put all their money in gold, and then they worry when we get a correction or their gold stocks don't go up?
Well, you see, I'm an advocate of investments that generate free cash flow. In other words, you invest in something and every year you get, after all expenditures, some money in the form of interest payments or in the form of dividends. And that allows you a lot of flexibility because, say, if you have all your money in physical gold or in exploration companies, the problem is you have no cash flow. So let's say your portfolio drops by 50%, you don't have any money to add to your position. Whereas if you have cash flow, every year some money comes in and you have a purchasing power to buy the assets that during that year fell the most or where you think that some value is emerging. And I think it's very important to have always cash flow to invest in opportunities. And so I also advocate essentially a diversification. You know, a few weeks ago, Mr. Buffett came out and said that gold is unattractive and so forth, and several studies will show that stocks over the long run have performed better than gold. I fully agree with these studies. It should be clear that the company that generates income and pays out dividends over time will perform better than a dead asset like gold. However, this is a big however. I once talked to Jeremy Siegel. He's written many books about the performance of stocks since 1800 and so forth. So I said to him, Jeremy, you start your book and the performance in 1800. Are you actually aware that by 1841, in the poor man's recession, most of the canal companies and most of the banks were bankrupt? So if you invested your money in 1800, by 1841, most of it was gone. And this is the point. In equities, you have to rebalance your portfolio. And in gold, you don't have to do that. It's a totally different type of asset. You can't compare it. And the other day, you know, Kodak went bankrupt. I remember in 72 and 73, among the 10 most popular stocks among institutions, you had Polaroid and Eastman Kodak, and both went bust over time. And they were disastrous investments. So it's nice to say the market is going up in the long run by this and that. That I agree. But you have to rebalance the portfolio. And in gold, you don't have to do that. Gold is basically cash that doesn't pay any interest.
Recently, Mark, I was at a party with some very wealthy individuals. Most of them, I would say, were retired. Their homes were paid for. What I found alarming in talking to individuals is that outside their homes, very few of these people talked or owned inflation hedges. No one I spoke with owned gold. One gentleman said, "Why would I buy gold?" He said, "It pays no interest or dividends." I wonder if you might talk about the risks to wealthy people face in an age of inflation. Many of these people are unaware, despite their wealth, that in an inflationary age, they could see their wealth decimated through either taxes or inflation, or in a worst case, civil unrest, as we're seeing in many countries in Europe.
Yes, that is correct. I mean, I'm not sure that gold would help you a lot in the case of civil unrest. But the point is this. If someone that you meet who is well-to-do and says, well, gold doesn't pay any interest, then tell him, at the present time, your deposits are not paying you any interest either. And in real terms, inflation adjusted, you are penalized. You are losing out by, say, 5% per annum because your cost of living increase are going up by, say, 5%, and the interest is zero. So in this environment, you have actually an advantage to own a sound currency like gold vis-a-vis paper currencies where the quantity can be increased. And by the way, you asked your well-to-do people once, when did you travel overseas the last time? Haven't you noticed how expensive Australia and Canada have become relative to the United States or Switzerland? And if they say yes, Canada is now very expensive, then you say yes, that is a symptom of U.S.